Hi, my name is Ram Sen, and this is a hedging strategy update on the cable. It can also be used by traders who try to capture big picture moves. We start by placing the current price action in the context of the big picture. You see that cables declined from about 2.82 in 1953 to a low of 103.20 in 1985. That's followed by a recovery, which is sort of the flip side of the dollar's collapse following the Plaza Accord. Then eventually you get to a post-1985 high of around 2.1, coinciding with the peak of the housing bubble, the credit bubble in the US. That's followed by the sharp fall, which is essentially the credit crisis unfolding, Lehman Brothers bankruptcy, etc. And then you have this drop, then you have a recovery coming up to this high, which is July 2014, a high of 171.92. From there you get the last phase, well, let me not say the last, the latest phase of the decline down to the post-flash crash low in the cable, which occurred on October 6th, I think. It seems to have happened on October 2nd. I think it's around October, so it's early October. It's a flash crash low in the cable. Happened in early Asian trading. So what we're going to do is now we're going to zoom in to this focus on this part of the price action, which is really of direct relevance to us. And so this fall from July 2014 down to the lows of October 2016. So let's move to a different chart view. This is a palette chart structure created with the Oanda, the new web interface for Oanda. And here what you see is basically an arrangement where as you move from left to right and top to bottom, so you go this way, then you come here, and then you go here. You go all the way, the time frame keeps, the snapshot frequency keeps getting smaller, so the granularity keeps increasing. So you have a monthly chart, weekly chart, daily, 8 hours, 4 hours, hourly, 15 minutes, 5 minutes. So you can see the price action in the very short term here. So what I'm saying essentially is that I'm going to quickly get to the view, and later on I'll explain the justification for the view, but by and large it's a black box strategy. I'm not bothering too much about with explaining how exactly I got to this view, because that would take too much time. So what I'm essentially saying is, remember that what we looked at on the big picture chart, the last stage of the latest stage of the decline from July 2014 here to the flash crash low. This is what's happening, and you see a small recovery developing here. Looks like a small recovery. The question is this recovery over? My answer is no, it's not over, and I expect in fact this recovery will go and take us to about 37.50 on this rally itself. So obviously we want to be going long. So now the question is, obviously, as you have to control your risk in a very disciplined manner, so if you're going long, you have to find a place below the market which has to be your stop. And that's also the place where you know that if I set a stop at a particular level and the market goes below that level, then you know that my view is wrong. So that also helps to, setting a stop also helps to make the strategy very specific. It makes the strategy statement a falsifiable statement. Right, so let's look at, since we've decided we want to go long, bullish on the cable, and waiting for the election to happen basically today, tomorrow. Results should come in by Friday. And where should we place our stop? At first cut, it appears the first statement I would make with regard to the stop is, look at this price action here. This is the flash crash low in the cable. After that you get a recovery, then consolidation for a while, and then you get a sharp breakout, and then you have a little bit of a decline. My sense is this corrective decline is over. Okay, so the first statement I'm going to make is this corrective decline is actually the low of 31st May. It's a low of 31st May, and it's around 127.69. So the first statement regarding the stop I'm saying is that the market is going to shoot up, breaking above the 130.50 high and going much higher en route to 37.50, and it's not going to break below 27.69, the low of May 31st. But even that seems quite far away from the current market, which means it's a very wide stop to consider. Can we do better on the stop? My sense is yes, we can. I'm going to actually suggest an even tighter stop. I'm going to suggest a stop just below the 6th of June low, which is around 128.72. So to sort of summarize, the statement I'm making is look for a sharp break in the cable to the upside, moving, smashing through 130.50 in the post-election frenzy, and not going below the low of 128.72, which was marked on 6th of June 2017. So if it goes below 128.72, you know my view is wrong, and that's where you should stop out of your longs and wait and reassess. And as far as so that's the stop, right? Now the question is, so when you know you want to go long, you know where the stop is. So the question is, should you buy at market or should you wait for a decline and a better opportunity to buy? So my sense is that I think you will get an opportunity to buy around 139.30. You see this rally here? This is where we are right now, pretty close to the June 7th top at 129.70. We're hovering around those highs, the highs of the day today. And as we come, I think that there's a chance to come down to around 129.30, perhaps even 129.10 in the post-election, frenzied price action. There's a chance we get that, and then those are the dips that you should be buying, and then use a stop of 128.72. And remember not to do this trade for more than 1% of account equity, and that would apply even to a hedger, because I think even hedgers need to use the concept of risk capital and then trade accordingly, just like speculative traders do. That keeps the hedging disciplined. Right, so that's the first part of my presentation, which tells you very specifically what's going to happen. And notice that this is a falsifiable strategy statement. It is so specific because I'm telling you the market won't go below 128.72. So the moment market goes actually does go below 128.72, if it does, straight away you know that my view is wrong. So this is a falsifiable view, a falsifiable strategy statement, and notice how it's very different from what you normally get on business television, which is a bunch of global statements which are not specific enough to be falsifiable. So next time somebody gives you a market view, try to push him into a corner and force him to give you a view which is falsifiable, because I think that otherwise it's not really of much use, because it's not actionable. Okay, this view that I'm giving you is directly actionable. All right, now let's move on to the fundamental justification for this view. How do I sort of justify my expectation that the cable is going to react to the upside so much? I mean, to recover so substantially. So let's look at what's actually what got us here. Okay, the most important point of departure is to look at the Brexit vote and the price action after that. So you see this sharp collapse after Brexit. You see a little bit of a consolidation, and then you see the second leg of the collapse, which is as we head into October. You have the sounds, the first signs of, the first noises of a hard Brexit. And on the day of the flash crash, there's news that Theresa May is leaning towards a hard Brexit. She's comfortable with it. And you also have François Hollande telling Jean-Claude Juncker that, I mean, essentially, that let's make an example of the Brits. Let's give them a really hard time. Let's make it really expensive for them to teach people a lesson, because otherwise, I mean, they've basically violated the principles on which the EU was based, etc. So what this means for the market as we head into early October, you get this kind of news. The market realizes, remember that it's still in a kind of a panicky state, having been traumatized by the Brexit vote, expecting catastrophic consequences for the economy, and then they hear that, wow, it's going to be a hard Brexit. Now that seems even worse than Brexit. So they sell it off, in panic. And remember, this is early Asian trading, very thin trading, conditions. Tokyo is not open, New York is closed. So in that kind of twilight zone, you get this sharp drop. And that's where the low is. The low is, I think the Reuters low is around 118.19. probably on EBS, and then you have another figure being posted by Oanda, which is 116.50. I'll go with the 116.50 because it allows me to be conservatively bullish in estimating my upside targets. But we keep in mind the fact that there is a lack of clarity on what the low exactly was on that day. So anyway, we have this. So basically, looking at all this, dramatic decline in the pound from about 1.5 down to 116.50. What is driving this? This is basically driven by the factor of Brexit and the tremendous fear that has been put into the minds of investors by the doomsayers and the people campaigning for the Remain vote, which included, by the way, Mark Carney, the UK Treasury, and pretty much everyone in the establishment, David Cameron, everyone telling us that it was going to be a disaster for the UK economy if they voted for Brexit. So when that Brexit vote actually happens, investors in a panic sell the pound off and cause this kind of a decline. And then, of course, as the news of the hard Brexit comes in, they're in even greater shock, and they set it off even more. And then you get this snapback reaction, a bit of a rally, and then the price action seems to stabilize. And notice that this is also around the time that we're starting to get news that maybe Brexit is not as bad as we thought. I mean, the consequences of Brexit are not as bad as we thought. Let's look at this news item on the Bloomberg from October 27th. Okay, we get a surprise rise in UK GDP. I think the estimate was 0.3. We got a rise of 0.5, and I think that now has been revised to 0.6. Then you already had Nissan committing to the Sunderland plant. You'd already had news that Masasi Son of SoftBank had decided to acquire ARM Holdings, which is the Cambridge-based boutique chip maker, so that was also a vote of confidence in the UK. That was seen that way. And so basically what we're starting to see now as the market stabilizes following the shock of the flash crash, you're starting to also get news. At this time we start to get news of economic data that pertains to the period after Brexit. And what we are finding out that, wow, the market actually, the economy is actually not doing as badly as people had feared. You see this article from Zero Hedge, which is January 26, 2017. Look at this. You can see the headlines here. All right, who can forget the doom and gloom? Yeah, so you can see the market now starting to get, positively surprised by the resilience in the UK economy. The market is having to revise its expectations about with respect to the UK economy, and you can see that. And you also have this famous mea culpa from Andrew Haldane at the Bank of England, admitting forecasting errors. We also know that Mark Carney, who was basically who had also given us very scary forecasts for Brexit scenarios, he was actually chastised by Theresa May and some other people in Parliament. Andrew Haldane admitting forecasting errors made by the Bank of England, who are now having to quickly revise their forecasts upwards for economic growth. And so what you're seeing essentially here is, you can also see here pictures from the Financial Times, essentially also saying the same thing. So it all adds up to a picture where what you're seeing is the market is now being forced to reassess the economic prospects for the UK following Brexit, because it's been pleasantly surprised. The economy has not crashed, and in fact it's actually doing quite well. If you see, for instance, Halifax House Price Index, that's also done quite well. In fact, now, just today we had a news release. The Halifax House Price Index is at 5-month highs. So various sectors of the UK economy holding up quite well. And so a surprise for many investors. So what you're seeing now, so this is basically now, here's a point where we first realize where that the sentiment cycle in the cable has actually turned to the upside, to the bullish side, because Theresa May announces snap elections and the pound shoots up, the cable shoots up. Now this is very interesting because snap elections, you know what she's trying to do. She's trying to strengthen her hand so that she's able to negotiate. She has a stronger negotiating position when she has to sit down with the EU. Article 50 has been triggered, and you know that Theresa May is leaning towards a hard Brexit. You know the Europeans are going to give them a hard time. They have to, because then otherwise everyone's going to start leaving. That's what they fear. So, and you know that the Brits are not going to be cowed or bullied, and Theresa May is not going to be cowed or bullied. So there's going to be a confrontation. It's not going to be pleasant. And in spite of that, cable has rallied sharply on the news of the election. So that to me is actually a proof that the sentiment cycle has actually turned to the upside, and now the market has to correct its errors, because essentially if you see the economic data, the performance of the economy post-Brexit, you can actually say that this entire sharp sell-off in the pound, from 1.5 all the way down to 116.50, that was a mistake. Certainly it was an exaggeration. If you could say that, yeah, long term there's going to be some damage to the UK economy, or at least the fears of the short-term cratering of the UK economy were overdone. So clearly the market, if it wasn't totally mistaken, it was at least partially mistaken, and it has to now correct its mistake. And that's what I think is going to drive this. If you notice now, the market is in a positive sentiment cycle. So you'll see that when you get bad data for the UK economy, the cable is not going to react that negatively. But if you get positive data, it's going to react in a disproportionately positive way. So the net bias on the cable is going to be to the upside. We are heading towards 137.50, and as I said, the stop is going to be at 128.72 as a first warning, and a bigger warning comes if you get a drop below the 127.69, which is the low of 31st May. Okay, that's when I'd really start to worry. So these are the levels once again to recap, and that's the fundamental justification for the view. I would add one thing though. Sometimes in this particular case we don't have that problem, but sometimes you get scenarios where you don't have a clear-cut fundamental rationale for a trade, but you can get a good sense of the price action. I think that in those kind of situations, people should be comfortable with going with the flow of the price action, because the market tends to anticipate fundamentals. So it's quite okay for the fundamentals not to be in place yet, but you see a move happening, you should just ride it as long as you're able to control your risk. Very, very tight risk control. The only thing you control in this business is where you get in, how big your position size is, and where you get out. And those three things determine how much you lose on a trade. Let's just talk about the downside. And if you can control your loss, that's the only thing you control in this business. So your entire focus of an investor has to be on tightly controlling the only thing that you can really control, and everything else basically is a lottery. All right, good luck. Cheers.